Are you an early stage founder revolutionizing the future of retail? Then you're in the right place. My name is Shah, and I'm an angel investor investing at the pre-seed stage in retail tech, e-commerce, and digitally native brands. I'm also the founder of Retail X Series, an in-real-life event series based in New York to help early-stage founders think through topics like customer acquisition, sales pipelines, branding, financial modeling, fundraising, and more. In this podcast, I interview founders and investors who've spoken at Retail X Series events in the past, and we dig deep into the tactics around key topics that early-stage founders want to hear about. Welcome to the Retail X podcast. Hello, everyone. Welcome to the Retail X Series podcast. I'm your host, Shah. Today's episode is all about getting ready to fundraise for your first outside capital. Our guest today, angel investor Rachel Wexler, will give us her advice, tips, and best practices for fundraising. Welcome to the podcast, Rachel.
Thank you. It's great to be here.
We're very happy to have you. So let's start with a little bit of background. Can you tell us a little bit about yourself and what you do now?
Absolutely. I'm Rachel Wexler. My angel investment vehicle is called New Paradigm Ventures. I'm also the co-founder of Black Iris, a women's apparel line that launched last year. And prior to entering the startup and VC world, I focused primarily on public equities investing as an investor at Allen & Company and a retail analyst at JP Morgan.
And moving now to what you're currently doing as an angel, can you tell us a little bit about your investment focus sweet spot, your typical check size, sort of what stage you're looking at, and whether you lead deals or just follow a lead?
Sure. I invest primarily in consumer-oriented businesses across different verticals. My first check is usually at the pre-seed stage and tends to be around $25,000. So I'm not leading rounds, but I do often follow on in later rounds.
And how many investments do you do kind of in a typical year?
Typically around 4 to 5 per year.
That's great. Okay, so before we get into the nitty gritty kind of details of fundraising and how founders should go about fundraising and how they would get a meeting with somebody like you, let's just generally set the stage a little bit. So you mentioned that you invest kind of at the pre-seed, and you're based in New York. So what are you seeing here in New York in terms of kind of seed versus pre-seed, in terms of size of raise and valuation? I know this is it feels like a little bit of a moving target, and people are, I think it might be different on the West Coast as well, but certainly here for our listening audience, like what are the differences between sort of pre-seed and seed?
Sure. Like you said, it's always a moving target, but what I'm seeing currently in the New York market at the pre-seed stage is typically a raise anywhere from around $400,000 to $2 million on a convertible note, with a cap between $4 million and $7 million. And then at the seed stage, I'm usually seeing companies raise $2 million and up at valuations starting around $10 million and going up substantially from there.
Great. That's really helpful context. And I think it's really interesting because I think every person you talk to kind of has sort of different cutoffs for that raise at the pre-seed and seed level. But it does feel like it's a moving target. And so I think it's helpful to hear that range that you're giving up between $400,000 and $2 million for a pre-seed round.
So, yeah, it's easy to get mixed up with all the nomenclature, but that is definitely what I'm seeing now.
Great. So now let's shift into kind of what investors like you want to see from early stage startups. So, we talk a lot to you and I, talk a lot to very early stage founders at that pre-seed stage. For you, what is the most important thing at pre-seed, which is obviously so early and there's probably not a lot of metrics there, but what's the most important thing to you when evaluating those companies at that really early stage? What do you focus on the most?
Yeah, so like you said, often at the early stages, there's no data, there's really no history or track record that you can look at. So for me, the most important things that I'm focused on are, number one, the team. So their level of drive, their passion, their background, how flexible they are to evolving their business model as they get new information post-launch, and then the business model itself. So is there some kind of moat or competitive advantage that positions this company to succeed? And what will the unit economics look like? And what's the path to profitability over the long term?
And that's a lot of stuff, right? So that's like the team and the business model. Obviously, one of the things a lot of investors talk about is sort of how big your market is. I mean, of kind of all of these different elements, like which one would you say is like the first thing that you look at, the first questions that you kind of ask yourself in a meeting with an entrepreneur?
Sure. So I think that the total addressable market, as you said, to me, that goes without saying. I focus on spaces where I feel like this idea could be a big idea. So that's kind of just table stakes to me. After that, it's really all about the team at the early stages. There are plenty of ideas that are good, but if executed by the wrong team, probably wouldn't be a winner in the industry. And if executed by the right team, could end up being the next big thing. So I think it's really all about the founding team and the early team. And that is what will drive the company to succeed or fail, regardless of what the idea is.
And when you say team, a lot of times in these really early stage kind of pre-seed companies, there's not that much of a team. There might be two founders, there might be one founder and a couple of interns and maybe an advisory board at the most. Do you take that into account when you are making those decisions? Like if there really isn't a full team yet, does that change your investment opinion?
So I tend to think a lot about what are the core skills and capabilities that will position the company to succeed. And if the founding team has a background in those areas, that is a huge plus. So for a company that is very dependent on marketing, do they have a marketer as a founder? That would be a huge competitive advantage. If not, have they identified talented individuals who will come on board after they raise capital? And will they be able to convince talented operators to join the company? So you definitely don't need all of the expertise in house on day one, but the ability to identify and recruit strong talent to join the team is very critical. So that's definitely something that I would look for, is the ability to find the right people and bring them on board, even if the skills aren't there on day one.
Yeah, absolutely. I think that's a really good point. And for the founders listening to this, I think it's something that I think a lot of founders feel like, oh my gosh, I don't have this fully baked team. How can I go out and raise? But how can I also hire those people if I don't have any money? So, having those people lined up that you can then go and hire who have committed to, coming on once you've raised some money seems like a really good strategy for founders.
Yeah, I think the closest that you can get, whether that's having a list of who you want to hire or some kind of soft commitment from them after you raise money, the closest you can get really shows investors what you're capable of and how far you'll be able to take things once you have that capital in your account.
Yeah, that's great. And then, we've talked a little bit about team. Let's talk a little bit about traction and sales and customer traction. So, at this early pre seed stage, how much traction do you really expect founders to have? What are there particular metrics that you're looking for, unit economics or growth trajectory? Like, you know, a lot of these companies, as we've discussed, are really early. There's not a lot there. How do you gauge traction?
So I have invested in companies pre-revenue and pre-launch. But even at that phase, it's very helpful to have some kind of MVP, a product already in development, and an understanding of exactly what you're offering to the customer. And that's another situation where the farthest that you can take things before raising that money is, to me, a really strong indicator of future success. A lot of it really is just about that hustle, finding ways to get things done, kind of fake it till you make it without having the capital there up front. And then for companies post launch, definitely understanding unit economics is a must. There's really no hard and fast rule, but I need to believe this company will be able to grow quickly and profitably by deploying the capital that they raise.
Yeah, it's funny that you talk about take things the farthest you can before you raise money. And I think that is a really good kind of rule of thumb for founders. Like, I have done every possible thing I can do, and now I absolutely have to raise money because I can't take it one step further. That feels to me like a really good litmus test of, are you ready to raise capital?
I think that's right. And many founders, maybe they have a full-time job and they're not able to leave that full-time job until they raise the money. But so in that situation, you want to know, how serious are they? And a way to show how committed you are is by doing everything in your power, given the constraints that you have with your full-time job and the fact that you haven't closed a round yet.
Yeah, that's great. That's great advice. Let's kind of take our sort of scenario of a founder who's coming to you, pitch you on their business. When they come to sort of start to raise that round, obviously they need to have a pitch deck. Tell me, what makes a good deck? One of the things that's very controversial in sort of the retail community is, should you pay money to have a beautifully designed deck, or does that even matter to investors? Is it good enough to just sort of have the content, and what sort of content, are investors looking for?
Absolutely. So the number one most important component of a good deck in my mind is a compelling explanation of why this company or product or service needs to exist. So showing what exactly the opportunity is and being able to get investors on board with that vision. Beyond that, a lot of commonly seen slides in decks mention the total addressable market, founder bios, unit economics, use of funds, advisors, any kind of mock-ups or product of the product or the website. And that's all very important, but it's really about those few key slides at the beginning of the deck that gets people excited about the vision. I think as it relates to branding, you do not need to spend thousands of dollars or more than that on branding just to put a deck together. But I do think for a consumer focused business where there is a product that you'll be selling in stores or online, it is good to show an understanding that brand and visual appeal matters. And so for those types of companies, you do the best that you can do. Have a friend who's a graphic designer, try to figure it out yourself and put something together that's visually appealing, just to show that you do understand the nature of consumer purchases. But for more of a B2B or tech kind of model, it's less important. And I think people understand where you're coming from at the very early stages.
And beyond the deck, is a financial model important to you? This is another controversial topic within, I think, founder community, which is, some people come in with like a 5-year model projected out month by month. Some people say, I'm not an Excel person. I don't even know how to start creating that model. What do you look for from companies at this early stage?
Sure. So what I would say first is that most experienced investors know that forecasts are just forecasts. It is very difficult to predict what will happen in the future. That said, I do believe it's important to have a financial model, more just to convey your knowledge of the financial engine powering the business. So investors, especially recently, are really focused on profitability in a way that maybe they weren't in the past. And so making that financial model work for your company is hugely important. So I don't think that you need to go overboard with, a 5-year, 10-year model with a ton of line items, but showing that you understand how the business works and have even an elementary use of Excel is important. So I wouldn't go totally overboard in trying to forecast every single line item, but I would definitely put a model together with a multi-year plan and targets.
That's helpful advice. So the 10-year model is out. I'm telling all the listeners, don't bother with the 10-year model. And what about other items of due diligence? What else besides a deck and some sort of model that talks about business levers? What else should founders be ready to share with angels like you?
Sure. So for companies that have already launched, the more metrics and data, the better. And the more that founders can show that they do have an understanding of the key levers driving their business, that's something that's great to see as an investor. And for companies that haven't launched, a lot of diligence will involve things like doing reference checks on the founders, talking to other angel investors that have specific expertise in the market, or even studying the paths of other companies that can shed some light on whatever deal it is that I'm looking at.
Got it. And should founders come to a meeting with you with an idea evaluation or terms, honestly? Or is this something that they should be working together with angels and other investors to pull together over time?
I think that companies should come to a meeting with some kind of potential range that they're considering. So it's definitely okay to express openness and flexibility as it relates to the terms of the fundraise. But without any kind of number, it can be hard for an investor to evaluate. So I would suggest coming up with a range, expressing that you are somewhat open to feedback from the investor, but not coming in with no numbers at all.
Yeah, that's good advice. And I think this is really a tough one for a lot of founders because they don't actually know. And then something that they might see, the comparables that they might see on the West Coast might have completely different valuation ranges than comparables they'll see on the East Coast. And it feels like there's a lot of information out there, but it's also somewhat opaque and really hard to sort of gauge where they should be. Are there any sort of rule of thumb or specific kind of numerical advice you would give to founders on this front about valuation?
So for companies that have launched, it can be helpful to look at multiples. So looking at what other companies are getting acquired for, looking at what other companies are raising at on a revenue multiple basis, or any other metric that's relevant for their type of company. In the early stages, it's helpful to just look at the early stage ecosystem and see exactly what investor appetite looks like for companies that are pre-launch. So I wouldn't say there's a rule of thumb, but I would focus on other companies and the market and what you're seeing based on that.
And what about structure? So you had mentioned earlier convertible notes at pre-seed, but obviously there's also safes. I think there probably isn't a lot of price rounds at the pre-seed stage, but I have seen them. Is there, as an angel, are there structures you prefer or structures you don't prefer?
Sure. So I usually see safes and convertible notes at the early stages, and both are accepted by investors. Most investors are more comfortable with a convertible note because it's a bit more investor friendly than a safe, but I tend to not see resistance to either structure.
Great. And so that's really helpful, I think, for the audience listening, because I think many times we have early stage founders in the retail X community who ask if they should be pricing rounds at the pre-seed stage. But certainly what I've seen, and it sounds like what you've seen as well, is that that's kind of the rare case, and that notes and safes are sort of the way to go, and frankly, a lot easier.
Yes, I would definitely agree with that.
And how should entrepreneurs run a fundraising process at pre-seed? So do you need a lead for the pre-seed? Do leads even matter at this stage? Is it likely that you're getting a VC lead? Is it going to be the angel round? Kind of what's been your experience in the companies that you've seen, particularly over the last, let's call it year or so?
Sure. So it depends on exactly how much capital you're raising and what you need in order to get things off the ground. So for larger raises, there's often a lead, but just as often I see early stage companies that don't have a lead. So either way is fine. And I do think having strategic angels on board can help in securing a lead. And I also think that having a lead on board can help in securing high quality angels that want to see that you do have an ability to raise institutional dollars should you need to in the future. So both are very complementary to each other. What I would suggest is going down both paths, because for better or worse, when investors see that another investor is on board, they might be more likely to invest. So as soon as you start to have people committed, you can circle back with other investors who you've spoken to earlier in the process and work on securing an investment from them.
I think that's really good advice where it might not really be a hard no, And I do think that there is value to certainly to keeping investors that you've talked to in the loop, even if they ultimately don't even say yes, because there's always another round, right? Later on.
Absolutely.
If you had to give advice, because I think this is the hardest part, and I think a lot of founders come and ask me this, and I'm not sure I have a fantastic answer for them, but how do you find those angels, particularly the ones like you mentioned that might be strategic to your business or have like relevant expertise that could be helpful? It's easier to find VCs. There's plenty of lists and articles and all kinds of things that you can Google. Angels are a little bit harder to find. How would you recommend that founders, who are going out for fundraising for the first time, find these angels that could invest in their businesses?
Sure. So I think a very good place to start is find people who have been very successful in the industry that you are focused on disrupting, and start there. Those are some strategic investors that could be great additions to your cap table. See if you can get in touch with those people from friends of friends. A warm introduction is certainly more effective than a cold email. Beyond that, LinkedIn can be a great tool. Angel groups like 37 Angels or New York Angels can also be effective. Some universities have angel groups. You can look on Crunchbase, which doesn't always have a comprehensive list of angel investors, but sometimes does. And I found that once you have tapped into a network of angel investors, if they're excited about the deal, they're happy to share it with other people. So start by looking for common ground, people who maybe you went to the same university of them, maybe you worked at the same company as them in the past, and take it from there.
And I think, you just, I think, alluded to this, that I think a lot of people don't call themselves angels. They may make investments, but they have a day job, they're doing other things, maybe within the same industry, to your point, but they could be interested in investing if you reached out to them. And I think that is probably the hardest thing for founders to figure out, to say, somebody who went to the same university as you, or somebody who's in the same industry who's been successful, they probably don't have on their LinkedIn that they are an angel investor.
That is 100% true. Many angel investors are in a full-time job, running a business, have run a business in the past, and angel investing isn't their core focus. And so I would not be afraid to reach out to somebody for help if you think that they could be a really good addition to your company in some way or another. Even if they just end up being an informal advisor, that can also be very helpful to you in raising money.
Yeah. I was talking to a founder yesterday, and I think one of the things I said was, cast the widest net possible. You have no idea who actually invests in early stage companies. You just don't know, as angels. And just keep talking to people and meeting people and building the network.
So true.
Yeah. Okay, so you've now kind of gone through this. You've looked for angels. You have a structure. You have maybe a sense of valuation. You've got your deck. You've got some sort of financial model. How long should this fundraising process at pre-seed take?
It is very difficult to answer that. I have seen companies wrap up fundraising within a week, but that is not the norm. I think the 4 to 6 month range could be a good target. At a certain point, you do want to shift the focus back to your company. But so anywhere between several weeks and around 6 months would probably be the norm.
And in that, as you go through this process, and maybe you're, like, you've got a bunch of investors sort of circled and committed. One of the questions, and this is very much related to valuation, so we probably should have talked about it back then, but how much of your company should you be giving up at this pre-seed round in terms of dilution?
Sure. So that's another area where there is a pretty wide range, but what is typical at that pre-seed stage is usually around anywhere between 10 and 25% is what I tend to see.
That's great. And I think it's very interesting because I think most founders who are doing this for the first time probably don't really have a sense of what is standard. So it's helpful to know that there is a range and not a particular number that is standard that at least you're seeing out there. So 10 to 25%, listeners, that's what it is. How do you feel about advisory boards? Meaning, do you feel like companies raising a pre-seed round should have advisory boards? Should those advisors be getting equity? Is that something important in your process?
Not important in my process. I've seen companies succeed who have great advisors or who don't have advisors at all. So it's not something that I care about as an investor. I think that every company is different. And if you have very strong advisors that you think can drive the business forward, absolutely go for it. What I would do is make sure that they have multi-year vesting agreements so that if things don't work out, they don't end up with more equity than they should have. But by all means, if you can find advisors that are helpful for your business or helpful in attracting investors, then go for it. And I don't think it's a good thing or a bad thing. It's just about what works for the founders.
That's really good advice because I think a lot of times founders are hearing that they have to have an advisory board and it has to have some really big, famous names on it as one of the prerequisites for raising a round. So it sounds like you're saying that that's not as important as people may think.
I don't think it's as important as people think, but it is a great way to get some kind of expertise or talent on board from somebody who maybe wouldn't make sense to have on your team as a full-time employee. So it is a useful tool in helping to drive things forward, but definitely not necessary.
Right. So a lot of times at this earliest stage, founders are kind of torn between a couple choices. So they kind of need cash. Maybe they don't have enough metrics to really raise around, or they're not sure. There are certainly plenty of accelerator and incubator programs out there, some of which do provide cash for some exchange of equity, some which don't. If you were advising a founder who kind of said, I have these two choices between kind of going to an accelerator or not doing that and actually just raising kind of maybe a small pre-seed round and moving forward, how would you advise that founder?
Sure. So I think it's very founder dependent. For a founder who is an incredible product designer, but maybe has less of a business background or a network and is looking to develop more of a network of other founders and back office team. For somebody like that, I think that an accelerator could be very useful. If you don't need it, it is certainly not a necessary step. So it helps to fill in some gaps in your own background and provides a structure and a community. So if that is beneficial to you, an accelerator can be a great thing to be a part of. And otherwise, it is more than okay to move forward without one.
That's really helpful advice. And I think a lot of times founders, I'm seeing a lot, I don't know if you're seeing this, are doing a variety of programs, some of which are more sort of classic accelerators, some that are maybe a little less about taking equity, but are about, founder support or things like that. And you're seeing kind of founders using these programs in different ways. And even after raising a round or two, still finding value in certain kinds of programs like this. So it does feel like there is no particular single path anymore on this front.
Totally true. And I've seen successful companies come from both paths. I would just encourage founders to do research on an accelerator before joining or applying, especially if you are giving up some equity. So make sure that it is a good fit for you.
Absolutely. That's great advice. Okay, so we've talked kind of a lot about process. We've talked about valuation. We've talked about how founders should think through raising a pre-seed round. That we haven't talked about is sort of the one most critical piece of advice that you would give founders as they go out to raise a pre-seed or even a seed round.
So my main piece of advice is to really nail that elevator pitch and be able to get investors interested quickly. People talk to a lot of founders and you really want to get their attention. So the number one way to do that is by practicing to anyone who will listen, friends, family, investors who may not be on your target list. So before going to your dream investor, I would meet with other investors, colleagues that you've worked with, and practice articulating your idea until you have it down perfectly.
I love that piece of advice. That is so true. I think it's so difficult to kind of really distill your company into a few sentences. And the more you practice, the better it's going to go. And I do think I completely agree with you that you have a very short amount of time to get an investor's interest, and you don't want to be like rambling about your entire backstory and history and how you pivoted 3 times before you got to this particular business model, etc. So I love that piece of advice. Thank you so much for that.
Of course.
Well, that is it for today. So, Rachel, thank you so much for sharing your stories, your experience, and your tips on the podcast. I really appreciate it.
Of course. Thank you so much for having me. It was great to talk.
And thank you to the listening audience for listening to the Retail X podcast. We'll have another new episode out shortly. Thanks for listening. If you'd like to attend a Retail X Series event in person, check out www.retailxseries.com for upcoming events in New York. You can also follow us on Twitter and Instagram at RetailXSeries. You can also learn more about me, find fundraising resources, or submit a pitch deck at www.redgiraffeadvisors.com. Thanks, and catch you next time.